What if everything you think you know about money is backwards? What if the dollars, the credit lines, the soaring stock markets, the government budgets, even the booms and recoveries you hear about on the news, are not signs of a healthy financial system, but symptoms of a carefully engineered illusion? An illusion so old and so normalized that most people don't even notice it. An illusion that keeps the system alive while convincing billions that everything is fine. Yet behind every bubble, every crisis, every sudden boom and mysterious collapse, this same mechanism quietly operates in the background, guiding outcomes most people think are just the economy doing its thing. Today, we're pulling back that curtain. Because this illusion has a beginning, it has architects, it has victims, and now after decades of patchwork fixes, it has cracks. Cracks big enough that you can see the entire structure warping in real time, even if you don't yet know what you're looking at. By the end of this video, you will dot to understand the illusion. We need to leave the present behind. We need to go back to a moment where money, power, and desperation collided so violently that the world financial system was forced to reinvent itself. And in that reinvention, something subtle entered the design, something that seemed harmless at first. A workaround, a stopgap solution, but eventually became the core engine of modern finance. This is a story of economies that couldn't sustain their growth, governments that couldn't balance their books, and societies that couldn't resist the promise of prosperity today in exchange for little debt tomorrow. It's a story of central banks, gold standards, political pressure, the rise of global markets, and the one change that silently rewired how money works. And here's the twist. The illusion didn't come from deception. It came from incentives. Everyone wanted more growth, more spending, more liquidity, more upward charts. And once the system found a way to deliver that, nobody wanted to let it go. Even if it meant replacing reality with a narrative. 1. The gold constraint. When money wasn't allowed to float for most of modern history, governments didn't have a choice. Spending was limited by what they physically possessed, gold reserves. If a government wanted to wage war, build infrastructure, or stimulate its economy, it had to pay in the hardest currency it had. A finite, unprintable metal. And that constraint mattered. Gold meant discipline, sometimes harsh discipline. During recessions, governments couldn't simply add more money. They tightened belts. They cut spending. They let banks fail. They allowed downward cycles to run their course. Painful. Yes, but stable. Also yes. And most importantly, not elastic. The system couldn't expand without more gold, and that limitation slowly became a problem. 2. Modern ambitions clash with old rules. Then came the 20th century world wars, industrial revolutions, global trade, giant corporations, consumer economies. Nations needed flexibility. They needed spending. They needed leverage. The gold standard became a cage. And in moments of crises, especially during wars, governments discovered something. If they quietly issued more claims to gold than they actually had, the economy kept functioning anyway. It was the earliest form of the illusion. A promise backed by, well, hope that nobody would check too closely. But eventually, people did. 3. 1971. The breaking point. By the late 1960s, governments, especially the United States, were spending far more than their gold reserves could justify. Vietnam War. Social programs. Infrastructure. Global commitments. Foreign nations began demanding their gold back, and that's when the world discovered the truth. The U.S. didn't have enough gold to cover its promises. So in 1971, President Richard Nixon made a move that shocked the world. He closed the gold window. No more conversions. The dollar became whatever the government said it was. And in the vacuum left by gold, something else quietly slid into its place. Debt. From that moment forward, money didn't represent a physical thing. It represented credit, a promise to repay in the future. And the illusion transformed from a workaround into the foundation of the global economy. 4. The expansion era. Growth on borrowed time. Once money was no longer scarce, governments could spend more freely. Central banks could print more generously. Banks could lend more aggressively. Debt no longer needed to be carefully controlled. In fact, debt became the fuel of prosperity. Consumers took on mortgages and credit cards. Businesses took on leverage for growth. Governments borrowed to smooth recessions. Wall Street created increasingly complex financial products to multiply credit supply. Everything went up. GDP. Housing prices. Stock. Indices. Corporate valuations. Government. Budgets. Consumer lifestyles. And for a while, it looked like the system had solved the ancient economic problem. How to avoid painful downturns. Except it hadn't. It had simply delayed them, stacking future obligations on top of an increasingly wobbly tower. 5. The side effects start to show every time the economy hit turbulence day. Asian financial crisis, dot-com crash, Great Recession, pandemic shock. The solution was always the same. Make more money. Issue more debt. Lower interest rates. Prop up markets. Stimulate demand. Bail out institutions. Eventually, the economy adapted to the new rules. The system became dependent on continuous credit expansion. Stopping meant collapse. So nobody stopped. The illusion wasn't that money wasn't real. The illusion was that growth was free. 6. Near zero interest rates. The system's lifeline runs out. For decades, lowering interest rates was the go-to fix. Cheaper borrowing stimulated spending, which lifted the economy out of downturns. But there was a problem baked into the design. Interest rates cannot go below zero for long without breaking the banking system. So across the world, in the US, Europe, Japan, rates followed the same downward staircase. 10%, 5%, 2%, 1%, 0%. Each cut bought time. Each cycle avoided a collapse. Each stimulus created the illusion of recovery. But once rates reached zero, the system ran out of runway. You can't lower interest rates below zero forever. You can't borrow infinitely without consequences. You can't keep inflating asset prices without pricing out entire generations. Something had to break. And it did. 7. Massive asset inflation. Housing. Prices separated from incomes. Stocks soared faster than corporate productivity. Wealth concentrated at the top. Cost of living skyrocketed. Young people stopped believing they could get ahead. The illusion had a winners and losers problem baked into it. Those who owned assets saw their wealth multiply. Those who only earned wages fell behind. 8. Fragile markets, fragile governments, fragile households. Because everything depended on perpetual credit expansion. One missed payment can topple a family. One policy mistake can trigger a recession. One market panic can wipe out trillions. One interest rate hike can bankrupt companies, governments, or entire countries. The system became a giant balloon, smooth on the surface, pressure everywhere inside. And every time the balloon deflates a little, global institutions rush to pump air back in. Governments introduced quantitative easing. They ran massive deficits. They implemented yield curve control, bank backstops, liquidity facilities, corporate bond purchases, mortgage support. Each policy was sold as temporary. None of them were. Because once the system relies on a fix, removing it is as dangerous as the crisis it was meant to solve. Imagine a patient hooked to a machine. You can't just turn the machine off because you hope the patient will recover. You leave it on. Now here's where things get uncomfortable. If you overlay graphs from different decades, say 1980s savings and loan crisis, the dot-com bubble, the 2008 mortgage crisis, the 2020 pandemic money surge, a repeating pattern appears. Credit expansion, asset boom, structural weakness, crisis, emergency intervention, even more credit expansion. Each cycle grows bigger. Each bailout becomes more expensive. Each bubble reaches new heights. And, today. And, global debt, public plus private, has crossed levels once considered unthinkable. Household debt, corporate debt, government debt, bank leverage, shadow bank leverage, pension obligations, derivative exposure. They're all tied to the same engine. The illusion that debt can expand forever without consequences. And consumers feel it. Housing affordability at record lows, savings rates dropping, costs of living rising faster than wages, pension systems under strain, governments unable to balance budgets, markets swinging on every central bank announcement. This isn't random. It's the downstream effect of a system that replaced tangible constraints with unlimited credit. 3 key takeaways. 1. The illusion is structural, not conspiratorial. No single group secretly engineered this system and evolved through incentives. Every crisis created political pressure to fix things now, and the fastest fix was always more credit. 2. Debt-based money creates artificial stability until it doesn't. Things feel safe until a shock reveals how fragile the structure really is. The illusion isn't that money is fake. The illusion is that growth can outpace fundamentals forever. 3. The next major shift won't be about politics, it will be about math at some point. Debt, interest, inflation, and demographic pressures simply stop being manageable with the old tools. When that happens, the system will need a redesign just like it did in 1971. Warning or open-ended thought. Here's the real question. When a financial system is built on an illusion, how do you transition to something more sustainable without triggering the very crisis you've spent decades trying to avoid? Nobody knows the answer. Not economists, not central banks, not governments, not markets. We are living inside a global experiment, one that has never been tried at this scale. And like all experiments, eventually, the results come due. Call to action if you found this breakdown eye-opening. If it helped connect the dots behind the headlines, then consider subscribing for deeper dives into the forces shaping global markets, policies, and the world you're living in. Share this video with someone who wants to understand how the system really works. Not the version you hear in press conferences, but the one operating beneath it. Stay curious. Stay informed and remember, the illusion only works when people stop looking at what's behind it.